This video is intended to focus on the question of whether to invest extra money into a tax-sheltered retirement savings plan, example 401k in USA or RRSP in Canada, or to pay down a mortgage balance. It presents a discussion on this difficult but necessary decision that is faced by many middle-income earners. I will demonstrate how to calculate one very simple ratio that can provide guidance for your unique situation. From these calculations, you will be able to see that for many middle-income earners who expect to have a lower pension than their working income, there is often a greater benefit by saving for retirement. It will also show that if mortgage interest rates are very high, this can affect the calculation such that it would be advantageous to invest as much as possible into the mortgage. Deferred tax schemes that are offered by governments are designed to encourage citizens to behave in a certain way by offsetting some of the costs. Some examples include save for retirement, get a post-secondary education, get married or have a common law relationship, have children, provide healthcare for disabled family members, donate to charity, buy a home. These financial incentives are often very generous. Everyone's financial situation is entirely unique, and so it would be unwise to claim that there is a one-size-fits-all approach to investment. For example, many people from the baby boomer generation lived during a time when interest rates were abnormally high and incomes were very low. For many of these boomers, and also for their parents, it usually made more sense to invest as heavily as possible into paying down their mortgage balance. For people who are in Generation X and for millennials, this approach may not be applicable. If you are of working age in the current era of low mortgage interest rates, often one-third of the rates paid by baby boomers, and if you're earning more income than your parents, the math may point you in a different direction. The average taxpayer is often confronted with decisions of fund allocation which can have very noticeable repercussions in the future. Mortgage rates and income taxes change over time, and so the answer will often change over the course of your career. Suppose that your salary is $80,000 per year. Your largest annual expense is likely your income taxes. Most people assume that their largest expense is their mortgage, and if their mortgage balance is very high, this may very well be the case. For those who own a modest home, however, the true cost of servicing the mortgage is lower than one would think, and so it is worth a closer look. A mortgage payment consists of two parts. The interest is the fee that you are paying the bank for the privilege of using their funds to buy your home. This portion is paid to the bank. The principal is the difference between your actual payment and your interest. This portion of your payment goes into your own home equity. Home equity is the part of the home that belongs to you, and so this portion of your mortgage payment is really being paid to yourself. Your mortgage lender can provide you with an amortization schedule which shows how much of your payment is going towards each of these two categories, or you can easily make your own in about 5 minutes using my other video. Add up the interest that you pay in the current year. If you cannot, or would rather not, go through your mortgage amortization schedule, then there is a simpler way that will give you a rough estimate. Your mortgage interest rate multiplied by your mortgage balance at the beginning of the year is equal to approximately your annual interest that you are paying. For example, if your mortgage balance is $800,000 and your mortgage rate is around 3% to 4%, then you are likely paying about $24,000 to $32,000 of interest for that year. Now that you know your total annual mortgage interest, set this number aside so that you can compare it to your income taxes in a moment. The dollar amount of total interest paid per year is good to know, but it can be misleading because even though it is quite high, it is not providing any insight into the benefit that you would get by allocating your additional funds to paying down your mortgage. Instead, the interest rate percentage is a more useful and relevant item that should be considered, since this percentage indicates how many dollars per $100 you will get back if you make an additional mortgage payment toward this loan. The interest rate indicates the benefit you will get, and this benefit is also known as your return on investment, or ROI. The next step is to dig up your latest completed income tax forms and look up the total tax payable amount. Be sure to include all of the income taxes that were paid for federal taxes, as well as the income taxes that were paid to your local jurisdiction, whether that's regional, provincial, and/or state income tax. For the purpose of this calculation, only taxes that are based on income should be included, and any other forms of tax that are not tied to income, such as value-added tax, property tax, flat taxes, etc., should be ignored. In Canada, the total tax payable is found on line 435 of the T1 General Form, or on the Notice of Assessment that the government sends out after having reviewed and assessed the tax package. This amount includes both the federal and provincial income taxes. It is important not to confuse total taxes payable with tax refund. The tax refund is just the amount that a taxpayer is getting back because their employer deducted more from the paycheck throughout the year than what ended up being calculated after the year was over. Total tax owing is the opposite of a refund. It is the extra tax that needs to be added to the paycheck deductions that were made during the year in order to have fully paid all of the necessary income taxes according to the calculations on the forms. The key is to use total taxes payable. The following is a very simplified version of how this calculation looks like on the income tax forms. Total income tax payable minus income tax already deducted from paychecks equals the tax owing, or the tax refund if it's less than zero. Now that you know how much total income tax you paid to all levels of government, the next step is to find your taxable income. This is the total amount for that year, which is multiplied by the rate for your respective tax bracket. In Canada, taxable income is found on line 250 of the T1 General Form, or it can also be found on the Notice of Assessment. The effective tax rate is a very important ratio that summarizes and indicates what portion of your taxable earnings went towards paying income tax, after all the complex inclusions, exclusions, and credits, etc. are fully calculated in all the various tax forms. Every dollar that is saved for retirement brings down the taxable income by $1, which reduces the effective tax rate. Total tax payable divided by taxable income equals the effective tax rate. Everyone's tax forms are different from each other and from year to year. This is the reason why a one-size-fits-all approach will rarely maximize long-term wealth. Now that you know your effective tax rate, you can compare it to your mortgage rate. Which one is higher? For many people, the effective tax rate is between 10% and 30%, and if they have high earnings, no children, are single, or have a partner who is also earning a middle income, this rate can be even higher. Imagine that you could put $10,000 into a retirement account, and in the first year, that $10,000 magically becomes $11,000 or $13,000. That extra money can be reinvested into the retirement plan to significantly improve the return on investment. One thing is for sure, this incentive will definitely make you reconsider the amount of time spent collecting grocery coupons. In fact, millions of people do not realize that they are in this category, and that they could reduce very easily their largest expense, which is income tax, just by using the tax-sheltered retirement savings plan that their own government will reward them to use. Financial asset allocation decisions are a lot like buying an apple tree. Some trees are huge and produce no fruit. Other trees are small and also produce no fruit. The best tree to buy is the one that gives you lots of apples regardless of its size. But unfortunately, most people are so focused on the way their investment looks, without paying enough attention to the yield. Let's walk through a quick example of how to use the information in this video. Consider an employee named Jake who is a single bachelor. His taxable income per year is $100,000. His total income taxes last year were $20,000. By dividing his total taxes by his taxable income, he finds that his effective tax rate is $20,000 divided by $100,000 equals 20%. He saved up $5,000 and is wondering whether he should put it towards his mortgage like his friend Brenda, or put it into his retirement savings account like his coworker Billy did. He wants to retire in 30 years. Option 1. Invest the full amount plus the tax savings into a very well diversified investment fund that is in a tax-sheltered retirement account, which is expected to realistically grow by 5% per year on average for the next 30 years. The investment plus the income tax savings multiplied by 1 plus the interest rate to the exponent of the number of years. This amount equals $25,932 after 30 years. Option 2. Skip the tax savings and invest the full amount into a mortgage with a 3% interest rate. The initial investment multiplied by 1 plus the interest rate to the exponent of the number of years. In this case, the $5,000 investment will become $12,136 at the end of 30 years. So in Jake's case, his money grows better if he invested in the diversified tax-sheltered portfolio because it pays a higher return in the long run, and because he gets the initial boost from the reduction in his income taxes, which are costing him 20% per year. On the other hand, his mortgage is costing him only 3% per year. So what's the catch? First off, there's a maximum limit to the amount that you can save in a tax shelter. Every country has a different limit and it can change every few years. The limit's pretty high though, so most people do not even come close to using up all the contribution room. Secondly, you have to save the money in a registered account and you cannot take it back out without some sort of penalty or income tax increase. Will my money be locked away so that I can't touch it until I retire? Unlike a company pension, which is tough to get your money out of, you can usually get your money out of a retirement savings plan account. There will probably be a penalty or you'll have to include the amount in your income when doing your taxes for that year. This is because the whole point was to reward you for putting the money away for your old age. In any case, the bank rep will let you know the rules beforehand, or you can read about their different accounts online. Won't a retirement savings plan mean that I pay more tax when I'm older? Not necessarily. If you have a very generous defined benefit pension, then yes, this might be true. But if you have a defined contribution pension or no pension at all, then you will likely not pay much more additional taxes during your retirement. The key is to give your money a chance to grow before taxes eat away at the savings. If I set up a retirement savings plan, does that mean that I'll have to invest in risky mutual funds, bonds, and stocks that I don't understand or trust? This is not always the case. Once your money is in a tax-sheltered account, you can choose to put it into a regular savings account. If you are not comfortable with the riskier investments, you can just say no to when your bank rep tries to encourage you to invest in various mutual funds. Most banks offer tax-sheltered regular savings account, but just a heads up, if your rate of return ends up being lower than your mortgage rate, you might be better off paying down your mortgage. Please note that the purpose of this video is only to alert tax-paying homeowners to research different options that many people are not aware of. The viewer is advised to perform further research to decide on the relevance of these items for their income tax package. Due to the sensitive nature and high level of risk involved in real estate investments and retirement investment funds, please consult a licensed financial advisor and local tax professional for more guidance that is specific to your situation.